Do you have trust? What do I mean by that? Really, what I mean by that is, do you have trusts? Meaning estate planning, etc., etc. Thank you for joining the Entrepreneur's Ultimate Toolkit presented by VastSolutionsGroup.com. Yeah, we're going to be going over trust. So if you'll recall, this is the 11th installment of a 12-part series, again, called the Entrepreneur's Ultimate Toolkit presented by VastSolutionsGroup.com. We've gone over entrepreneurial issues from the outset of the starting the company, from its idea formation all the way to marketing, utilizing AI in your business, all the way to, well, down the road, legacy or insurance planning, everything in between, taxes, financial planning, the whole list. Well, right now we're going to go over trust. So that's the reason we ask, do you have trust? Actually, trust for estate planning, etc. Yeah, they use trust for estate planning purposes. A lot of people have questions. I was just dealing with a client who's worth well over $200 million, and he had no clue what his trusts were about. So here we're going to go over what the trusts are and give you a little bit of a snippet to understand a little bit about trusts. Many of us perceive trust as really complex subject matter, really better left for wealthy people. However, a trust is simply a contract initiated by a grantor or a giver who agrees to transfer assets, money, to a beneficiary who then receives the assets as stipulated in the contract, which is called a trust. Now, a trustee, who may also be the grantor, by the way, manages the trust assets and ensures the stipulated terms of the trust are faithfully executed. A trust is designed to help individuals manage a variety of family and tax-related estate planning concerns. Here are a few ways in which trusts can be used. Revocable living trust. A revocable living trust is an estate planning trust that deeds property to an heir but allows the grantor to retain control of the property during his or her lifetime. Upon the grantor's death, the property passes to beneficiaries, avoiding probate, which is the judicial process wherein a court appoints an executor to carry out the provisions of a will. While the revocable living trust does not provide tax savings for the grantor during his or her lifetime, the trust becomes irrevocable upon death, and the beneficiary, therefore, is then entitled to tax advantages. Now, I should mention, VastSolutionsGroup.com does not do any law. We don't practice in law. We don't do anything that we really should not with respect to law. We have 3 different attorneys who work on staff, either contract, etc., who help us working with these types of clients. Now, what I would also say, it's important to note, we don't do any law, so we force that to other entities. And we, though, are keeping a very close eye on, because we're part of the usually general manager team and helping clients who are entrepreneurs in dealing with estate planning issues or trusts. Now, let's go on to the next topic. The next type of trust, irrevocable living trust, which is, it's an estate planning trust wherein a grantor does not retain control of the assets or property through the transfer of assets or property into the trust. The grantor may be eligible for certain tax advantages. An irrevocable living trust may also be used to avoid probate, as one would think. Now, an ILIT, or irrevocable life insurance trust, is an irrevocable life insurance trust which is designed to provide tax savings through the ownership of a life insurance policy. Assets in the trust are generally not considered part of a grantor's estate. ILITs may be funded or unfunded. With a funded ILIT, income-generating assets are transferred into the trust, and the generated income is then used to pay the premiums of the life insurance policy. With an unfunded ILIT, the grantor makes yearly gifts to the trust, and the money is then used to pay the premiums on the life insurance policy. Credit shelter trusts. I just had a call about this last week. A credit shelter trust, also a bypass trust, is an estate planning tool used to protect assets from successive estate taxes. While current law permits an unlimited amount of assets and property to pass to a surviving spouse without being subject to federal taxes, children and other beneficiaries must pay taxes for inheritances valued in excess of certain exclusion amounts as described by the IRS. If a married couple wishes to take advantage of a credit shelter trust, they generally arrange for certain assets to pass into the trust for the benefit of the surviving spouse rather than passing all the assets directly to the spouse. This trust, by the way, which would not be considered part of a surviving spouse's estate, and by the way, does not generally exceed the applicable exclusion amounts, which may pay their surviving spouse income for life, and then upon his or her death may pass also to the beneficiaries. As an example, a child free of estate taxes if under the exclusion limit, by the way. In addition, the gross estate, sorry to get so technical there. In addition, the gross estate of a surviving spouse upon his or her death could pass to the same beneficiary. CRTs, we're doing one of these right now. Charitable remainder trust. A charitable remainder trust is an arrangement in which assets are donated to a charity, but the grantor continues to use the property and or receives income from it. A CRT may allow the grantor to avoid capital gains taxes on highly appreciated assets, receive an income stream based on the full or fair market value, depending, of those assets, also receive an immediate charitable deduction in the year that it was done, and ultimately benefit the charity of his or her choice. Also, let's go kind of fast forward to a dynasty trust. This is a trust used by individuals to pass wealth to their grandchildren, and it's free of what's called generation skipping transfer taxes. So, in sum, a trust can be a very effective way to accomplish your, long-term estate planning goals, but often involve complicated tax laws. That's why I say, we work with tax professionals, or I should say legal professionals, and also tax professionals who can help in this regard. Now, remember, this is the 11th installment of the Entrepreneur's Ultimate Toolkit. So we're rounding third base, but what I want you to think about is some of these issues as we've progressed have ballooned to become more and more complex. At the end of the journey, we're now talking about sometimes maybe in preparing for retirement or in retirement or starting to do some family planning. All of these things add up to a lot of really intricate things for business owners. Business owners and entrepreneurs shouldn't be thinking primarily about this stuff, but they should employ professionals who can help. That's what we do. That's what, let's say, your financial professional can do, your attorney, your tax professional, wherever the case is. You should be meeting with your tax professional, your lawyer, your legal professional, and your financial professional on an ongoing basis to talk about all these items that we've talked about as we're now rounding third base. We're getting towards the last installment of, as we've discussed, the Entrepreneur's Ultimate Toolkit as presented by vastsolutionsgroup.com. Once again, thank you for taking the time to listen to this podcast. I hope it's been of value since you've waited this long. Please email einstein@vastsolutionsgroup.com. In the subject line, put book. We will send you a copy of my new book, The Entrepreneur's Manifesto, a collection of smart financial advice. I just got a great recommendation or referral based on this book, so I got to think it's going to be of some value for you. Once again, Kenner French, vastsolutionsgroup.com, signing off, and thank you.